In this video, we're going to look at static budget variances. We will do that by building a static budget, which is really just the budget that the company would have made before the beginning of the current operating year. We're going to compare that to the actual results, and the difference between those two is the static budget variance. So let's start out by looking at our company, the Outdoor Outfit Company. They make a variety of jogging suits, and we're going to specifically look at the women's jogging suits made out of grade A nylon. So that is a particular product that it produces. It gives us our planned sales of 10,000 jogging suits and our standard prices, costs, and input quantities. There is no inventory of finished goods. That would complicate these calculations a bit. Then it gives actual sales in units and actual revenues, costs, and quantities of inputs. We're going to take this information and use it to create a static budget and then to create an actual results budget. So you might want to take a screenshot. Turning to a blank spreadsheet, I've got some formatting lines in here, but we're going to start out in column E with our static budget. The first thing that we're going to put into the static budget are the units sold. We had planned to sell 10,000 units. The revenue for the static budget was $105 per unit times 10,000 units gives us $1,050,000. Next, we're going to go to variable costs. We're going to do this like a contribution margin statement and separate our variable costs from our fixed costs, but we're only going to be looking at production costs in this video. So let's start with direct materials. Our direct materials budget was planned to be $6 per yard for fabric times 3.5 yards per jogging suit times the 10,000 jogging suits that we had planned to sell. And so that gives us 210,000. Next is direct labor, and we had planned to use 2 hours per jogging suit at $18 per hour, again times the 10,000 jogging suits gives us $360,000. Our last variable cost is variable manufacturing overhead, and that was budgeted to be $80,000. If we total those, we'll get total variable costs of $650,000, and if I subtract that $650,000 from our revenue, that leaves $400,000. We're going to go ahead and add the fixed manufacturing overhead at this point, and that is $60,000. And if I subtract the $60,000 from the contribution margin, I get $340,000. Now, what label should we put on the $340,000? Well, we have covered the direct materials, the direct labor, the variable manufacturing overhead, and the fixed manufacturing overhead. So actually, we have talked about all of the manufacturing costs involved, and that turns this into the gross margin. So in this case, we have both contribution margin and gross margin. We don't have any selling and administrative costs in this video at all. Next, we want to build our actual budget, and we sold 12,000 units. The revenue for those 12,000 units was given as $1,320,000. Our direct materials cost was $261,000. Direct labor was $570,000. Variable manufacturing overhead was $110,000. That gives us total costs of $941,000 and a contribution margin of $379,000. The fixed manufacturing overhead was really $55,000, and so the actual gross margin was $324,000. Next, we want to start calculating the static budget variances line by line. We want to look at whether each variance is favorable or unfavorable So let's look at the first one. Even though this is in units and not in dollars, we can calculate this variance. We sold 2,000 units more than we had planned. Selling more units would typically raise our gross margin, contribution margin, all other things being equal. And so this is a favorable variance. The same thing goes for revenue. We're going to take the difference between 1,320,000 and 1,050,000, and that gives us 270,000. Because the actual results are higher than the budgeted results, and this is a revenue, this is a favorable variance. More revenue, favorable variance. Dropping down to the direct materials variance, we have a higher expense in the actual column than in the budget column, and that makes this an unfavorable variance. More expenses lead to lower gross margin or operating income, all else being equal, and so that makes this an unfavorable variance. Direct labor, likewise, is an unfavorable variance. Variable manufacturing overhead is also an unfavorable variance, and my total variable costs is an unfavorable variance. I could have arrived at that $291,000 two different ways. I could have taken my actual results and subtracted my static budget, and that would give me the $291,000. Or I could have added together each of these variances. They're all unfavorable, so they could just be summed. A few things to think about at this point. I'm not taking one column minus the other column consistently. I'm looking for the larger number to give me an absolute value in my center column, in my static budget column. I prefer to get an absolute value difference and then think about whether it is favorable or unfavorable and add a label to it, than to just say we're going to take column E minus column B and then try to figure out if the positive or negative numbers are favorable or unfavorable. That changes whether they're a revenue or a cost. I think it makes more sense to think through the process. The contribution margin, likewise, we have a $21,000 difference. If we examine the two contribution margins, we can see that the static budget had a higher contribution margin than the actual results, and so regardless of the fact that we sold more units, this is an unfavorable variance. Once again, there are two different ways we could arrive at this variance. We could have taken the revenue variance of $270,000 favorable and netted that, in other words, subtracted the total variable cost since it's an unfavorable variance, and we would get $21,000. Of course, that's a negative, and we would then have to interpret it. I subtracted not because I was taking revenue minus variable costs, but because I was having a favorable and an unfavorable variance. So if the total variable cost static budget variance had been favorable, I would have added those two numbers. The other way that you can get the $21,000 is to take the static budget and subtract out the actual results. And of course, I chose to subtract in that order because the static budget was higher. Had the actual results been higher, I would have taken that number and subtracted the static budget instead. I'm just looking for the absolute value of the difference. Fixed manufacturing overhead variance is $5,000. Because the actual costs were lower than the budget, this is a favorable variance. Favorable does not necessarily mean good, and unfavorable does not necessarily mean bad. I have a favorable variance for fixed manufacturing overhead, but I would wonder why my actual costs were lower than my budgeted costs. Did I forget to pay something? Was a mistake made in the records? Has a contract changed? Why would my fixed costs be lower? And so that is, even though it's a favorable variance, something that I'm concerned about. Finally, my overall gross margin variance, or my overall static budget variance, is $16,000 unfavorable. Once again, I can get this number more than one way. I can take the static budget, which is higher, and subtract my actual results, giving me the $16,000. Or I could have taken the unfavorable contribution margin and netted that against the fixed manufacturing overhead. Again, one is unfavorable, one is favorable. They need to be netted instead of summed. So now that we have all of our static budget variances, the question becomes, what have we learned? We know that we sold more units than we had anticipated, and so we have more revenue than we had planned. That's a good thing. We have more expenses than we had planned, but logically thinking about that, if we produced more units than we had planned to produce, then we should use more, for example, direct materials than we had planned to use. And so those unfavorable variances are expected. However, we also have an unfavorable contribution margin, which means that those expenses must be proportionately too high, or we would end up with a positive contribution margin. Finally, I'm concerned about the fixed manufacturing overhead variance. We need to look at that. But in general, even though we sold more units than we had planned to sell, we made $16,000 less gross margin than we had planned to make. So something is going on. The problem with the static budget variance, there is so much that could have happened that looking at this, we can't figure out exactly what did happen. What we need to do is we need to take our flex budget and put that between actual results and the static budget and use that to separate this static budget variance into two pieces. And that's what we're going to do in the next video.